Marc Giannoni and Arvind Sanger are with us to take some questions on what they made of things. Gentlemen, great to have both of you here. Thank you very much for your time. Marc, let me start with you. The market reaction yesterday maybe is what flummoxed some people, or maybe the commentary, and of course what led to it, as I said earlier, is Powell saying that 50 basis points is not the new pace and kind of painting a rosier picture of the economy. In that sense, I mean, rate cuts which are needed by weak data are bad news, but you don't have that weak data and you get a 50 basis point cut. It's kind of the best of both worlds. Would you be inclined to view it that way? What's your sense?
Thank you very much. Good morning. Absolutely. I think the overall economy in the U.S. is still doing really well. I think growth is still very solid. GDP growth in the second quarter was 3%. In the third quarter, we expect something north of like 2% in real terms. So pretty solid growth here, still supported by a consumer. So then the question is, why is the Fed cutting? I think the Fed is cutting because it sees that inflationary pressures have really come down, that they feel confident that inflation is turning and returning sustainably towards the 2% target. And at the same time, the labor market, which is the other side of their mandate, seems to be at full employment, but is easing, is cooling. The labor market is cooling, and they want to make sure that they keep it near full employment where it is, and not that it gets into more weakness. So I think what we saw today is really on the part of the Fed an effort to recalibrate their policy stance by really bringing down the funds rate to a level that's more consistent with the easier labor market conditions and also the lower inflation, and make sure that they don't endanger the labor side of their mandate.
Fair enough. Arvind, what is your sense? I mean, ultimately the question is, what does it mean for markets from here? Can it provide fresh impetus to global markets? I mean, India has, of course, been a league of its own, a clear outlier in that sense. But all said and done, it's a for the lack of a better phrase, it's a happy cut. I mean, it's not a sad cut. Go on, Arvind.
Yeah, well, I think that's an interesting way to put it, happy cut. I can't disagree. I think the reality is that 5.5% is a tight condition for where the long-term neutral rate may be. The long-term neutral rate may be, 3.5%, 4%, as the Fed sees it right now. And 5.5 is clearly tighter conditions, and with inflation rapidly diminishing and maybe closer to 2.5%, not quite 2%, but at the same time unemployment rising, the risk of staying too tight too long is the risk that we could tip the economy over into recession. Clearly, right now the economy is not looking that weak, but it could weaken if the financial conditions remain tight well past the neutral rate. So that's why I think the Fed may be admitting that that they might be a little behind the curve and they should have done 25 in July and 25 now. They didn't explicitly say that, but I think that's what is implied by this 50 basis point cut in one shot, is to make sure that the financial conditions get towards neutral much faster. And the other question, I think that helps global liquidity, yes, markets and risk capital.
All right, so then that begets the question, what happens to emerging markets? The US cuts rates by 50 basis points, with 50 basis points slated for this year as well. So where do you see emerging markets headed as a result of this? And on that, India itself, I mean, it's already run up. People are talking about valuations at one extreme here. Do you see this as an incremental positive for India or incremental positive for emerging markets ex-India?
Well, if I were to answer this, I would say that if you look at the US market today, the best performing part of the market was the Russell 2000, which is the value part of the index, not the growthy part, NASDAQ. India is like the NASDAQ. Other emerging markets may be more like the Russell, more value parts. So on a relative basis, I would say the value out of favor may benefit at the margin more than the momentum part of the market, which is India. but it doesn't mean that money will not flow into India or to emerging markets in general. So I think India will benefit, but I think some of the laggard markets may be the bigger winners if financial conditions ease rapidly, as the Fed futures are indicating.
Marc, hi, great to be having you in the conversation today. Let's talk about other asset classes as well. I mean, what does this rate cut cycle mean for commodities? Because that really ties into what we can expect on inflation next. And also, throw in a word on the other major central bank, right? Tomorrow, we're all watching out for the Bank of Japan. And I think the expectation is that at least tomorrow they won't do anything. But a section of the market still believes that if they need to hike, they will, irrespective of what the Fed is doing. Would you agree?
Yes, I mean, I think whereas for the US, there was a lot of uncertainty about whether, in fact, they would do 25 or 50 basis point cut. I think that, people over the past week have really moved around these expectations quite a bit. But I think overall, the path for the funds rate is pretty clear. The direction is downward. The question was, 75 basis point by the end of this year, 100 basis point by the end of this year. Now it looks like it's more going to be 100 basis point at the end of this year, with another 25 basis point cut in November, another 25 basis point cut in December, as based on the SEP. But broadly speaking, this is not really changing the market expectations. So whatever the commodities were pricing in and the other central banks were pricing in is not radically changed by this new policy decisions today, irrespectively of all the uncertainty that we've seen over the past week. I think what's pretty clear is that the Fed is going to be cutting more. It's going to be. It made very clear this, I think, today that it's not going to cut rates at a very rapid pace. It's no longer going to do 50 basis point. It's more like in the 25 basis point range, unless we see a very substantial deterioration in the labor market. And so I think in that respect, they project an economy that remains quite resilient, continues to grow solidly. That's going to be favorable for overall global economic conditions and supporting the world economy as a whole, as well as commodities as a whole.
Sure, Marc, that point's well taken. So if this continues to be a gentle rate cut cycle, then I think the markets will absolutely love that. But just finish the other point on the BOJ as well. Do you expect the BOJ to continue hiking? And if that happens, then, I mean, I don't know, what precedent do we have where one major central bank is cutting and the other is hiking?
Well, they still have a large discrepancy in terms of rates, in terms of levels. And there are different stages of the cycle. The Bank of Japan is also dealing with inflation at a different cycle than the US. So, as part of where they are going, they may converge eventually, but for the time being, they may well proceed in different directions.
All right, gentlemen, thank you very much. Great to have perspective from both of you today. There's plenty to think about and plenty to discuss, and we'll keep doing that over the course of the coming weeks as well. The new rate regime has only just started.